Right, good afternoon, everybody. Thanks for being in today's session. This is Adrian speaking. I'm the head of trading here at Trend Signal, and today we're going to be talking about how to trade news and events. So there's going to be a bit on the charts, there's going to be a bit looking at some of the theory the beforehand, and then we're going to look at what that means in practice with regards to our charts as well. So there's going to be quite some good stuff going through today. So whether you're new to this or whether you're quite experienced, hopefully this will be quite insightful and of good value to you. So just want to make sure the sound's all coming through loud and clear, and then you know how to interact as we go through today's live session. So if you're on GoToWebinar, which I'm sure most of you probably are, but we are also streaming on the likes of YouTube and Facebook and so on. Although interaction's a bit harder there because I end up with chat windows all over the place, makes it very, very difficult to follow. GoToWebinar, however, if you're on the tablet, smartphone, that sort of thing, you're going to see this little thing on the right hand side. You can use the questions box here, just hit the question mark and then a little keyboard magically pops up and all that good stuff. If you're on a desktop, laptop, computer, it might look something like this. And again, either way, you're looking for a question mark, questions, chat, something like that. So you can type the question in. So if you wouldn't mind, if you haven't done so already, or even if you have, do it again. Just type hi in that questions box for me, just so I know it's all coming through loud and clear. That'd be fantastic. Thank you. This is where you can ask questions during today's session. If you're not so sure about anything, you want to me to cover off on it again, repeat it, and so on, say it in a different way, that sort of thing, then just type that in and I'll be very happy to do so. Ultimately, the purpose of this is to be a little bit more, I guess, educated, a bit more aware by the end of this session than you were than when you were started. So you can help me out just by being involved and interacting and all that stuff. So today we're going to be talking about how to trade news and events, but obviously we need a little bit of a backdrop to that as well, in terms of, well, what sort of news and events and why are they important, really? What sort of an impact do they have on the markets? Well, we're going to go through all of that, but also why. Why does it have an impact, and why does it affect the markets in the way that it does? I think it's important to always understand why something happens in a particular way. I think it's very easy to just be told something and then you could take it at face value. But if you don't understand why, then you're probably going to go off and break the information that you were told, or do things in a different way because you don't know perhaps the importance of it and what have you. So we're going to focus on some of those whys and wherefores today also. Okay. Before we get into the subject matter, just a quick disclaimer here. I won't read the whole thing, but spread bets and CFDs are complex instruments that come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. Okay, so let's get going with it, really. I think a lot of this with trading is down to an ability to follow rules and to be disciplined. Now, what's interesting, and I've got a testimonial here from one of our members who've been through our training program, and I could sit there and highlight how well this person's done, but actually it's this section here that I think is the most important. And why am I bringing this up today in today's session? Because news and events makes it very, very important to follow those rules as well. As it says here, if you can follow rules, take your time and listen to your coaches, you'll make money. If you don't listen, have no patience, and can't follow rules, go and do something else because trading is for you. I think that's a fascinating way of articulating that, and I think it's absolutely spot on. What we're going to be looking at today with regards to news and events has the ability to dramatically affect price. We're going to be looking at the market stimulating events that can change the direction of price or have significant impact on, massive moves, massive candlesticks, things that are going to go on to impact price as well. And if we're not disciplined in the way in which we deal with that, then we can lose an awful lot of money. Okay, arguably we can make a lot of money as well, but I think on balance, we're probably going to end up on the wrong side of it, or at least the risk is of that being the case. So I think when we go into something, we need to be aware of the risks and so on, and news and events can present that as well. It may not be totally, you think all the risk side, that's the boring stuff, all the stuff I don't really want to know about, but you have to. And actually, in knowing that, you can then look to turn that to your advantage as well. And we're going to talk about that as well when we look at some charts shortly. Okay. Um, I think the first point I really want to make here is that, if we're not a little bit careful here, if you like, then it can be a little bit of a gamble. Okay, so news and events, we could be talking about economic data, we could be talking about earnings for a stock. These are the sorts of items that can have a dramatic impact on price. Why? What impact we'll go through in just a second, but the fact of the matter is that they do. For example, if you're going to trade a stock, let's say at a buying opportunity for tonight, it's quite important to know that when it's about to have its next earnings results, when it's about to report on its quarterly performance or its half-year performance. Why would that be important? Well, the stock price is going to be heavily affected based on a perception of how that stock's going to do into the future. So if the investors currently, the marketplace is pricing in an expectation of X amount of profit, but their earnings results come out and say actually it's going to be half of X, well, the valuation of that stock is going to be greatly affected. Now, we don't know or hear about things that really affect that particular stock on a day-to-day basis. It's more about the economic cycle and so on. But the stock itself will report on a quarterly or half-yearly basis, depending on where it's listed. So it is the earnings results that really give us a direct bit of information about how well that company is performing. That then allows any investor to reevaluate its decision to hold that stock and then make decisions with it. So you can get huge impacts on price because maybe it's not as profitable as we thought it was going to be, and therefore the stock price can fall dramatically. Similarly, with foreign exchange, with indices and commodities, we can have the same sort of impact by, yes, corporate results with regards to the indices, but also economic data as well. So interest rates, non-farm payroll, consumer price index, or inflation data, particularly important at the moment. So it all has the potential for a similar impact like corporate earnings. So, for example, if the value of the pound is based on the inflation rate being X, but new data comes out to say that actually it's quite a bit higher than X, you'd be like, oh gosh, if inflation's really high, they're probably more likely to raise interest rates and so on in order to slow the economy down, or whatever it may be. The fact of the matter is that you can have dramatic impact on currencies based on new information coming to light. And normally the market will move in its own weird and wonderful way, but you have these action points at certain times of the day and the week that can really stimulate much bigger movements and changes in direction. If you think of it this way, I heard this on a podcast about a couple of years ago, and I thought it was a really interesting way of saying it, that the market will typically carry on the direction it was originally going unless new information comes to light. So what might that new information be? What sort of thing could impact the direction of price? Well, how about potential interest rate change? How about inflation? How about growth data being higher or better or worse than expected? And what impact does that have on us as traders? Well, the shorter the time frame that we're going on, the greater the impact. So if you're going to trade on something like a 2-minute chart, the more important, the more aware of economic data you should be. Trading off a daily chart, the less relevant it becomes. It can still be sometimes relevant, but less relevant than certainly for a day trader. Rafid, how can you figure out when some things are factored in the price of the market? I think you kind of have to go on the basis that the market is always factoring these things in. Okay, so by the time you've digested what's happened, the market probably already has done so. So actually, it's not, for me, I don't look at the news and think, oh, wow, that company is doing really well, therefore I should buy it, because arguably the market has already moved up. It's already in the price, shall we say. I might then look at the chart technically and say, oh, it's going to give me a buy signal, and the uptrends and so on in place, that I might go on to take action. But what I don't necessarily do is get all fueled and invigorated by some economic data that comes out, and I just want to ride that economic data, because by the time that you and I can react to it, it's already had a significant move. Okay, and that could well be the end. It might stop at that point. So we have to be a little bit careful about just sort of, being a little bit just jumping in. The chart will tell you what's happening. Okay, so the thing about economic data, and we're going to talk about the most important economic data items in a second, but the fact is that they will have a big impact on price. What I encourage you to do is be mindful really of that. Because if you're going to trade over news and events, whether it's corporate earnings, whether it's economic data, there is a risk of gapping and a risk of slippage. So quick question, everybody. Do we know what gapping and slippage is? Just give us a yes or a no in the questions box, and then we're going to cover it anyway, but I'd like to get an idea about how you guys are really. Do we know what gapping and slippage is? So gapping and slippage is basically something that happens in faster markets, or when when new information comes to light. So gapping is basically a big jump from one price to the next. Basically, you'll be more familiar with gapping over a weekend. So it's kind of obvious to think of it in this way: is that if a market trades 24 hours, 5 days a week, like Forex, for example, that when you look at a Friday night close, let's call that 10 p.m. UK time, 5 p.m. Eastern time. The market will then close, and then it will reopen on Sunday night, let's say again 10 p.m. for ease of reference. So that basically means there's 2 full days there where there's no trading going on. But there might still be something that happens. There might be a change in sentiment. There might be some sort of announcement, I don't know, that can impact the valuation, the perceived value of the pound against the US dollar, for example. So the pound dollar might close on Friday night at 113.00, but it might open on Sunday night at 113.50. That will be a gap in the price. It's like it's jumped from 113.00 to 113.50, and that is potentially an issue. So that's what a gap basically is. And you'd also see similarly with the stock market. So the difference between its closing price last night could be different to the price at which it opens today, for example. That's a gap. And gapping in itself can create a problem called slippage. Okay, so for example, let's go back to that example that I said with sterling dollar, that if I was trading pound dollar and I had a stop loss, let's say it was at 113.00, it closed on Friday. I was short and I had my stop loss in at 113.25, and then the market opens at 113.50. Where am I going to get stopped out at? So my stop loss is at 113.25. That's where it closed at 113.00. My stop loss is 113.25. I'm short, and then the market opens again on Sunday night. Where am I going to get closed out? Am I going to get closed out at A, my stop loss, or am I going to get closed out at B, the opening price for Sunday? Let me know, guys. What do you think? Would it be A or B? Okay, the answer is more likely to be B. Okay, does that mean you shouldn't trade over the weekend? No, not really, because actually slippage doesn't happen all that often over the weekend, but it's more likely to be B. Now, why is that the case? It's because if I'm short, I'm looking to buy back my order to close. How can I buy? I can only buy if someone's prepared to sell to me. Okay, so they don't want to sell at 113.25 when they can sell at 113.50. That's a higher price for them to sell at. I'm sure they'd prefer that. So I'm only going to be matched with a seller at the rate at which a seller wants to sell at. So my stop loss might have been at 113.25, but however the market's gapped up a little bit over the weekend, so I'm going to be filled at 113.50. Okay, so this is what happens. So that difference there, that's like a 25 pip slippage. That's relatively big, to be fair. Effectively, slippage is the difference between the price you are filled at and the price that you hoped to be trading at effectively. It's like the difference in that. And that can be exaggerated on fast moving markets. It can also be exaggerated when the markets are gapping, which fast moving markets have more gaps in them. Okay, is this making sense so far, everybody? Are you all with me? Okay, so slippage is a thing. It's not something we have to be too concerned about, I think, but it's something we have to be aware of, particularly understanding when the risk of slippage can be higher. Okay, so when is slippage more likely? When is gapping more likely? Over economic data, over corporate results, potentially to a lesser extent over the weekend, probably more so over a bank holiday weekend and so on, but really corporate results and economic data. All right. So if we are aware of those situations, then we can look to reduce and factor in slippage and gapping into our trading as much as possible. So I don't think personally it's something to be scared of. It is something to be aware of. Okay. Um, So how would that manifest itself in terms of a chart? Well, let's have a little look. So I've got an example here. Now, these prices are way different. This is a really old screenshot, but it doesn't actually matter because it still demonstrates the point quite well. So let's say you had a buying opportunity, left-hand chart there. Let's say you had a buy for whatever reason, and you were looking to buy at, well, what would that be, 154.35. And why would you be buying there? Well, for I don't know, whatever your strategy is, it doesn't really matter. But at that particular time of the day, on that February the 20th, on that Wednesday at 9:30, you've got a buy trade on an intraday chart. That's what is that, a 15-minute chart. So you're looking to be in a trade for an hour or so. The problem is something new is about to happen. And what is that? Well, up here, by looking at your economic calendar, you can see at 9:30 that morning in the UK, they were announcing the change in the claimant count, but also Monetary Policy Committee meeting minutes. So this is what the Monetary Policy Committee have been discussing with regards to interest rates or quantitative easing, depending on where we are in the cycle. The point is that that's quite a big deal because when people look at information like that, it gives you a lead on what the likely impact of interest rates could be going forward. Are we more likely to raise rates? Are we more likely to reduce rates than we might have known beforehand? So this is the point. This is new information. We might, at 9:29, we might have perceived the UK interest rate policy to be X. But these minutes, we digest those and read those. Oh my God, actually, no. No, we're not thinking that anymore. We're thinking something else. And therefore, the pension funds, the hedge funds are going to be changing their portfolio. They're going to be doing this, that, and the other to react to that potential new information. So being aware of the high impact items of information there can allow us to reduce the risk of slippage. Because what happened? Well, had you have taken a buy trade, you'd have had an absolute stinker on it, to be honest with you, because the market dumped and dumped very, very quickly. But you wouldn't do it because you'd have been aware of the information coming through, because you should know not to trade, certainly to day trade over economic data or major economic data. Tarek, slippage is the difference of the price of order and execution. That's basically right, Tarek. So what you've had here is a massive gap down in the market. So again, if you are entering here and your stop loss is here, where are you more likely to be filled, at A or down at B? Probably more likely at B, unless you get a little bit lucky. Because remember, you have to be matched with somebody. And if that happens really quickly, if that drop happens within a nanosecond, then you're going to be matched with the first available buyer, which could be all the way down here. Because again, a buyer doesn't want to pay up here when he can pay down there. So again, economic data is important. If you're going to play golf, you need to be aware about where the out of bounds, where the water hazards are, and so on. This is it. This is the trader's equivalent of a whopping Great Lake in the middle of the fairway. You just need to know where these things are, and that's it, really. So okay, so we understand that we perhaps shouldn't trade over data. Why does it move as fast as it is? A lot of people think that the market moves fast because there's a significant amount of trading that happens. That's not necessarily the case. It can be the case, but not necessarily. The reason the market moves fast over economic data is because of what's called the market depth, the depth of the market. So the depth of the market is made up of all the different buyers and sellers that are out there. You know, your grandma who's trading, your cousin next door, your shopkeeper, your wherever, your hedge fund manager, your pension fund, all of these are making up the market. Okay. And at any market, there is a certain number of people and contracts that are looking to buy the market, and there's a certain number of people and prices that are looking to sell the market. And that gives us effectively what's called a price ladder or a depth of market. Because for any price higher than where we are right now, there are orders working to sell. Okay, they might be short orders, they might be orders to close along. Whatever it is, they are sell orders. And all prices below the market, there are orders, limit orders working to buy. So they're trying to buy this market. What happens is that as the market approaches economic data, then a lot of these traders are thinking, well, I've got this order in to buy here. I don't know, 113.35, whatever. I know it's not the same market. Again, it doesn't really matter. I've got this order in, but that's fine. But the problem is, with this economic data comes out, I don't want to be buying this market until I'm able to digest what this happens. So it would be pretty mad for me to continue to have this order in to buy this market because I just don't know what it's going to do. It could be awful. The market could absolutely dump and I could be left there holding the baby, if you like, when I don't want to be. So actually, what's more likely to happen is as you approach major economic data, well, actually, they'll probably decide to cancel that order. And that person might also look to cancel that order. It might be 10 people that make up that full size, but they might all decide to cancel that order. So what ends up happening is that you get what's called a thinner order book. Okay, so the number of orders that are there become fewer, and that means you get bigger gaps between prices. Okay, so what that means is that the market over economic data can jump a little bit more because the depth of the market is thinner. There are fewer participants with an order in the market at those points. So it could be that there's significant volume going through. It could be that the market's just super thin. So you can get really fast moving markets even on a bank holiday because there's just not much trading going on, which means that the market's just a bit jumpier, even though it's still moving quite fast. So what you end up with here is effectively an understanding that if over economic data, lots of institutions are cancelling their orders so they can just monitor it and take a view, then what ends up happening is you get jumpier, spikier moves, which can lead to faster moves on the market, which can then create more slippage because ultimately you can only close a trade if somebody wants to take it off you. So there we are. Is this all making sense, everybody? Are you with me? Hopefully, I'm not bamboozling everybody. It's just, some of you probably think, well, this is a bit frightening, isn't it? It's not really, because we know when these events are coming through. And we should also start to know and start to understand what are the more important economic data items to be more aware of. So what are those? What do we as traders need to be aware of? Well, this can vary a little bit depending on where we are in the economic cycle, but broadly speaking, a lot of this comes down to interest rates. It comes down to monetary policy. There is really nothing more important to an economy or a price of a currency than the interest rates within that country. Okay, so for the pound, the most important thing that could impact the pound is the likely interest rate change or interest rates perception for the UK. Okay, similarly with the dollar, the thing that's going to impact the US dollar the most is what happens to interest rates. Okay, so there's a little clever hack for you, if you like. Whenever you think about how might this currency move based on inflation, based on GDP, based on sales data, all you need to think about, okay, so sales data is quite strong. That was higher than expectations, which means that, the economy could be overheating, which means we might need to raise interest rates to slow the economy down. So therefore, if in the US sales data is higher than expectations, you'd expect the dollar to go up. Pretty straightforward. If it was lower than expectations, then you'd expect basically, we might need to stimulate the economy a little bit. We might need to cut interest rates to reduce the demand of saving, if you like, because it makes saving less attractive. So you're going to go out and spend more and stimulate the economy that way. So actually, if sales data is lower than expected, you'd expect the dollar to fall. And that's basically how it works. Pretty straightforward in that regard. The most important items for interest rates, therefore, are the interest rate announcements themselves and the minutes associated with them. And also in the US, the US is a little bit different to most other central banks. That in the US, the FOMC has two mandates. The primary mandate for most central banks is to control inflation and to keep it within a certain level. That's why we're getting there's lots of interest rate change at the moment because inflation is going through the roof. The central bank's primary requirement is not the economy, it's to control prices, to control inflation. So they're not concerned about these other things because their mandate is not for soft landings. Their mandate is for controlling interest rates, inflation, which is why some people are thinking, well, God, why are you raising rates at this point? Well, because they kind of have to. Because it's just to control the inflation, which is a bit of a crisis at the moment. But in the US, they have another mandate. The FOMC is also there to foster full employment as well. So that's why some of the most important data announcements in the US are to do with unemployment data as well. So non-farm payroll, which is typically on the first Friday of each month, and also interest rate data does tend to be the highest impacting announcements that come out. As well as that, you have key speakers coming out, inflation data, so consumer price index, producer price index, GDP, so growth data, and so on. They can be pretty important as well. Consumer sentiment, effectively, high impact data can have a big impact on price, and we're going to have a look at that in a second. So, but largely speaking, it all comes down to all of these things is what would the data do to interest rates going forward? That's really all it ever comes down to. Okay, so let's have a quick look at a economic calendar, shall we? So this is Forex Factory. There are plenty of them around out there, and you can look at any week, and I can see the economic data announcements they're setting up for this particular week. Now this is set. Let me just refresh this page. With me. This is set to UK time. This is weirdly slow. What are you doing? Okay. So what I can see on any day by looking at Forex Factory in the calendar there is to see the major items that are being announced in any given day. And the way this works, I'm not going to spend too long on this, but effectively you have an impact column here, which is quite helpful. So this gives you an idea on how big an impact each of these economic data announcements is likely to be. So, for example, yesterday, on Monday, the 3rd of October, in the US at 3 p.m. UK time, that's 10 p.m. Eastern time, it was a US item of information, and it was the ISM manufacturing PMI. Now, this is a red item, which means high impact. Amber means medium impact, probably not so relevant, and then the yellow ones are pretty super not relevant. Okay, but basically you can click on these to get a bit more information. The way in which it all works is that it's based on the forecast. So you have a forecast based on all the economists that are out there of what that reading is expected to be, and then eventually you end up with the actual. Now, when we talk about stuff that's priced in, the market is expecting that number to be at 52.5. Whatever the hell that means, whatever item of data it is, that's what it's expecting it to be. The impact on the market will be determined by the actual item and the actual result. The market will price in this forecast, okay? If the announcement comes in that it is not 52.5, then the market is more likely to react. If it comes in at 52.5, all other things being equal, you'd expect the market not to do a whole heap because actually we're expecting it to come in that level, which means the market's already priced that level in. If it comes in at 50.9, the reaction could be quite big because that's a reasonable amount different to 52.5. So arguably, the larger the separation between the actual announcement and the forecast is the greater the impact likely to be seen on this market. Okay. which way it goes and so on. It depends on the type of market you're trading, whether it's an index or currency pair, but effectively that basically is like, oh, that's quite a lot of new information to digest, and therefore that could be quite a big impact. Again, let me know if this is all still making sense. We don't need to be an economics whiz kid to understand all of this. You don't have to understand about manufacturing PMI, how it's measured, and so on. All you really need to look at is, well, what are these high impact points? What currency is it likely to affect? Or in America, so it'll affect indices as well, of course, but it'll affect the dollar mostly. And what's its forecast? What's its actual? And what time is it? Okay, what it is not actually as relevant, to be honest. We just need to know that something is happening. So you don't have to be an economics graduate for this. So what that basically meant is that at 3 o'clock yesterday, there was something coming out that's likely to have a high impact, particularly if its actual number is quite a way away from its forecast. What does that mean? It means that if I want to avoid risk, I should not be in this trade at 3 o'clock. If I'm trading pound dollar or the Dow at 3 o'clock or 259, I'm a bit of a nutcase. Okay, the reason for that, I'm either a nutcase or I'm misinformed, because actually what I should be doing is thinking, oh god, there's a bit of a risk of slippage here, risk of gapping, new information that's going to change, could potentially change the direction of this market. I would rather be away from it. Would I then trade the reaction? Yeah, I would, because the market is then taking on new information that can push the market really quite far. So that could actually be a really exciting time to trade. But at that time, at bang on 3 o'clock, as a day trader, do I want to be in pound dollar? Do I want to be in the Dow? No, I don't. 2 minutes past 3? Yeah, maybe, depending on my strategy. Does that make sense? So my risk of slippage is at bang on 3 o'clock. So you can remove that risk by simply not being in the trade, just like I showed you with that slide earlier. Let's have a quick look. Actually, this is a really good example, and it's great to see one that's so relevant and so recent. This is a really good example of the impact and what can actually happen. I'm going to show you our dynamic trader charts, and I'm going to go back to what happened at that 3 o'clock time point, because actually it's really quite an interesting example. So what you've got at 3 o'clock, this is 3 o'clock here. Oh god, that's the least straight line I've ever done in my life. Let me do another one. So this line here is 3 o'clock. Okay, so the close of this candlestick A was at 3 o'clock. Now the reason this is important, because actually at bang on that close there was actually a short trade on this dynamic trader system. Okay, so no, it wasn't actually, but it doesn't matter. Let's assume that it was. Then you'd be looking to enter a sell trade, a short trade there. But that's on information that has been very quickly shown that something else is coming out. Because the economic data came out, the market then suddenly jumped, what, 120 points in 2 minutes. So that bar is a 2-minute bar. This market put on a 120 point move in 2 minutes. Okay, if you were short at that point, which you absolutely shouldn't have been, then you'd have had a bit of a shocker. And even if your stop loss was here, you probably wouldn't have been filled there. You probably would have been filled up there. So as long as you're able to have a quick look at the economic calendar, which is really easy to do, all you need is the internet, to be honest, you should be away from the market at that stage. Pretty simple, right? What then happens is that this creates, this data, because it was a little bit away from expectations, it created a market stimulating event. So actually, after that point, the market started to speed up. And it ended up with a really nice buy trade, because the marketplace was starting to digest this new information. Oh, we thought that ISM manufacturing data would be in at 52.5, and my portfolio is based on that number being 52.5. But actually, oh my God, it's only coming at 50.9. Oh my God. Pension funds, hedge funds, they're repositioning their portfolio based on this new number, this new element of information, and they're moving stuff around. They're selling this, they're buying that, whatever it is that they're doing, it's creating movement and an increase in volume, no doubt, that actually we can start trade. This was actually a buy trade here. So this is a standard buy trade with Dynamic Trader, and it ended up being a really nice buy. Now, Should I have been in the market before the data? Absolutely not. Should I trade the speed that has now been injected into this market? Absolutely. Why wouldn't we? Because it is that that's creating movement and actually makes it probably the most exciting time to trade. So what ends up happening there is we end up getting a buy trade that actually rallies from there. So what's that? 29,150 and rallies up to there. What, 200 points in about 25 minutes. That's how far this market moves. Okay, actually ends up being what at a had you run this trade according to the stop there, you're looking at what about 280 point objective maybe. Some of our traders might, you might have got out earlier, whatever. Doesn't matter. The point is, it put on a whopping great move, and it was a really nice trade. And it's actually that we really need to think about. Here represented risk. Here represented opportunity. Risk, opportunity. And all we need to be thinking about there is the news. And news is what creates movement. Okay, it creates changing directions. It creates decision points for the pension funds and the hedge funds. And let's not forget, they are the ones that move this market. We don't want to trade against them. We don't want to guess what they're doing. Let's follow what they're doing. They give us the lead. The market rallied. Okay, I have no issue buying up at price B rather than guessing at point A because, God, I don't know if my guess is going to be right. But point B was joining the party. Wow, it's already going up. Woo, let's jump on it. Without quite so many emotions like that. But the point is that it ended up being a really nice move, as we see all of the time. How do we just do it? How do we trade news and events, which is really what the topic of today's is? We simply are aware of the news. We decide not to trade into the news as a day trader, and then we trade the reaction to that news, because it is that creates the movement. Of course, you need a strategy to be able to do this, and that's something that we can assist you with, but the practice should be of being careful before the data and then trading the reaction to it. This week is quite an interesting week because we've actually got a couple of bits coming out this week, and on Friday we've got non-farm employment change. 1:30, first Friday of this month. That's likely to be a high impact item. Will that lead to a trading opportunity with Dynamic Trader? I don't know. We'll have to see what happens. Will it lead to a big move, a big change in direction? I don't know. We'll have to see what happens. It depends on how different. This is expecting at the moment 265,000 jobs created over the prior month. It depends on what that number ends up being. If it ends up being 200,000 or 400,000 or whatever else, there could be quite a reaction that as day traders will be very interested in. Okay, so we just need to be aware before you start your trading each day. If you're a day trader, just be aware of the high impact items. Maybe set an alarm to say, I've got this coming out maybe 5 minutes before, just to make sure, just to remind you, help yourself to close that trade out. So for example, ADP non-farm employment change is coming out on Wednesday, 1:15. Maybe set an alarm for 10 past 1. Are you still in the Dow? Yes, I am. Bugger it. Okay, let me close it out now. That sort of thing could be really useful. Takes 2 seconds to do, a little bit of prep there, just to make sure you're on the right side of the risk. Because actually, apart from anything else, even if you're not in a trade, it's like, oh God, yes, right, okay, 1:15. Okay, well, let's have a look at it then. Let's be at my desk, and then I can trade at sort of, 16 minutes past, 17 minutes past 1, and we'll see if there's a big reaction. Because again, if that comes in with 200,000 jobs created, it's probably not going to do a whole heap. But if it comes in at 300,000 or 100,000, I don't care which way, to be honest. From a trader's perspective, we might care economically, but from a trader's perspective, we don't really care because it's just a market movement stimulating event. Okay, and that's mostly it, guys. Question, everybody. Was that useful? Did that make sense today? Give us a quick yes or a no, please, in the questions box. That'd be great. I haven't really got a great deal more to say on the subject. I mean, clearly, we've been talking a little bit more about the sort of the intraday type of trading perspective rather than more end of day trading. But certainly have a look at that. Take a screenshot of this slide if you want to be aware of the more important data items. But if you're a day trader, this is more relevant. For an end of day trader, it's less relevant, and it's certainly nothing I personally, if I'm more of an end of day trader myself, it's less. It's certainly not something to worry about too much. But for a day trader, a short-term day trader, you need to be on this because otherwise you're just bringing too much risk in. Okay, risk that look, we all work hard for the money we make, whether it's through our jobs, whether it's through our trading. We shouldn't be so quick to hand it back to the market, should we? So just think a little bit about the risk. The more we can manage the risk, the more the profits will look after themselves. Horribly corny, really, but it is what it is. That's the realities of this. So, guys, look, we have end of day trading courses. We have day trading courses here as well. So, if you're interested in short term day trading, you like to follow us in a live trading room and so on, we can absolutely help you with that. If you rather more trade on a much more passive way, sort of in the evenings, again, we can help you with that as well. So, if you would like a call, maybe you'd like to discuss our trading programs and our courses, just pop your phone number into the questions box and we can give you a call and go through what we do and how we could look to help you. Otherwise, there's some information there as well. But like I said, hopefully that's been useful today and you learned a little bit more than it's a bit more learning, a bit more information perhaps than you had before today's session. That would be great. Otherwise, everybody have a wonderful week's trading. Keep an eye out for non-farm payroll on Friday and all the best and thanks for attending. Bye for now.